If the world stops buying your debt automatically, you do not have a bond market problem. You have a regime problem. That is the first thing I would tell you. The second thing is even less pleasant. Most people will not recognize the danger when it first arrives because it does not look like a dramatic collapse. It looks like a slightly weaker auction, a slightly higher yield, a slightly worse rollover, a few foreign sellers doing what the financial press says is perfectly rational. It looks manageable. That is how these things begin. Not with a siren, with a shrug. I want you to think about the United States Treasury market the way I would think about a giant refinery built on borrowed money for years. Crude came in on schedule, buyers lined up for the output, and the financing behind the whole structure looked so dependable that nobody bothered to ask what would happen if one of those assumptions changed. Then one day, the easy buyers stopped behaving automatically. Not because they hate you, not because they are evil, because they have their own fires to put out, their own currencies to defend, their own energy bills to pay, their own political pressures to answer to. That is where we are. And when the automatic buyer starts stepping back at the same moment, the borrower faces the largest refinancing wall in modern history. The question is no longer whether the system is elegant. The question is whether the system can still fund itself without paying a much higher price than the public has been prepared to imagine. That is the hidden subject of this entire cycle. Not one bad month, not one ugly chart, not one geopolitical shock dependence. Dependence on demand that used to feel permanent. Dependence on foreign reserve managers continuing to play the old role. Dependence on a market big enough to absorb endless supply without asking harder questions. And once dependence becomes visible, strength starts looking very different. I have watched this movie enough times to know the sequence. The crowd sees a headline. The serious money studies the funding chain. The crowd hears that foreign central banks sold tens of billions in treasuries and thinks this is just another number in another nervous month. The serious money asks a colder question. If the most natural external buyers are stepping away while the sovereign must refinance roughly $10 trillion, who exactly is supposed to absorb that paper without demanding a higher price? That is not rhetoric. That is the whole case. It is the case beneath the yield, the case beneath the dollar, the case beneath the war, the case beneath the word safe haven itself. People throw around the phrase safe haven as if it were a law of physics. It is not a law. It is a habit, and habits can break. A reserve currency is not protected by mythology. It is protected by confidence, discipline, depth, and the broad expectation that when stress arrives, the world still wants more of the very asset you are issuing. What happens when stress arrives and the world wants less? That is the right question, not because America vanishes, not because civilization ends, because repricing begins. And repricing inside the world's benchmark funding market changes everything else downstream. Now let me explain the mechanism the way I actually see it. The first mechanism is what I call the forced seller rotation. When oil spikes because a major supply route is disrupted, oil importing countries do not get the luxury of reading long-term white papers about reserve strategy. They need dollars. They need them fast. Oil is priced in dollars, their own currencies weaken, their import bills explode, and the reserve asset they have on hand, the one large liquid pile sitting there waiting to be turned into dollars, is usually U.S. Treasuries. So they sell. Not because they finished a 10-year strategic review and concluded America is over. Because energy invoices are due. This matters because the financial press loves to flatten everything into one level of analysis. Foreign central banks sold $82 billion, fine, but why they sold matters more than the number itself. If the sale is driven by energy shock and currency defense, then the Treasury market has just revealed something extremely important. In a modern geopolitical crisis, foreign reserve managers may liquidate treasuries instead of accumulating them. That is a regime shift, not total collapse, not end of world language, a regime shift. And regime shifts are where fortunes and mistakes become permanent, because investors who still think they are living in the old regime keep using the old assumptions long after those assumptions stop protecting them. The second mechanism is what I call the refinance wall. Most people hear that the United States must refinance about $10 trillion of debt, and their eyes glaze over. The number is too large. It becomes theater. I do not let large numbers become theater. I translate them into strain. Here is the translation. A huge amount of debt issued in a world of near zero rates is now maturing in a world where rates are materially higher. That means old cheap promises must be replaced with new expensive promises. And every basis point matters when the principal is measured in trillions. If you refinance $100,000 at a higher rate, you feel it. If you refinance 10 trillion, the budget begins to change its shape. And once the budget changes its shape, politics changes its tone. This is why I do not think of the debt as a static object. I think of it as a living pressure system. It rolls, it reprices, it compounds, it feeds on the difference between yesterday's rate and today's rate. That is what turns a debt number into a liquidity event. The public is still looking at the headline debt total. I am looking at the refinancing treadmill. That treadmill is what exhausts systems, not the number alone. The need to keep rolling it at worse terms. That is why I care much less about whether the next auction is merely weak and much more about the cumulative effect of repeated weakness across a mountain of maturities. One weak auction is news. A year of expensive rollover is structure. Structure is what I care about. The third mechanism is the yield spiral. When natural demand weakens, the borrower must offer a better deal. In bond language, that means higher yields. Higher yields make the new issuance easier to place, but they also make the cost of carrying the debt higher. That larger interest expense widens the deficit. A wider deficit means more borrowing. More borrowing means more supply. More supply means the market again asks for more yield. That is the spiral. And spirals are dangerous not because every step is dramatic, but because each step makes the next step more likely. This is the part many investors still refuse to internalize. The bond market is not just a place where the government borrows. It is the measuring device for whether the system still enjoys funding privilege. Privilege means you can issue enormous amounts at low cost because the world assumes your paper is the obvious place to hide. When that privilege weakens, the issue is not psychological. It is mathematical. You lose room, and systems with too much debt and less room do not enjoy soft landings. They enjoy more policy improvisation, more market stress, and more transfer from productive public spending into debt service. That is the fourth mechanism. I call it the interest rent state. A country can survive many things, but once a growing share of national resources is spent simply servicing yesterday rather than building tomorrow, the quality of the entire system changes. This is why I keep coming back to net interest cost. $1 trillion a year, then more again as old debt rolls into higher rate debt. The average person hears that and thinks, well, the United States is rich. Yes, rich entities can still suffocate if their obligations reprice faster than their productive capacity. A rich household with a giant mortgage at the wrong reset rate can still lose the house. A rich company with too much short-term debt can still fail. Richness is not a shield against bad structure. The United States has immense assets. It also has immense obligations. And the market increasingly appears willing to price those obligations with less automatic kindness than before. That is the issue. Not insolvency in the cartoon sense. Structural crowding out interest payments that consume oxygen. The money used to service old borrowing is money not used to build capacity, reassure allies, fund productive investments, or stabilize the social contract. This is why debt service is never just an accounting line. It is political, economic, and moral all at once. A nation that increasingly works to satisfy its creditors is a nation with less room to satisfy its future. The fifth mechanism is the safe haven refusal. This one should bother you if you are paying attention. During a real geopolitical shock, you would normally expect treasuries to catch a bid. That is the old script. Scare the world and money runs into the deepest sovereign market. But if yields are rising and auctions are weak while war risk is elevated, then the market is telling you something that should not be ignored. It is telling you the safe haven response is not automatic anymore. Again, that does not mean no one buys treasuries. It means the historical reflex is weakening enough that other forces, supply, inflation, deficits, foreign selling, can overwhelm the old script. That is a big deal, because once the world's supposed refuge starts behaving like a security that must constantly prove itself under stress, the architecture built on that refuge becomes less stable. Everything is layered on top of treasury pricing. Mortgages, corporate debt, valuations, discount rates, fiscal math, reserve management. If the foundation becomes more volatile, then the rest of the building starts adjusting whether people are emotionally ready or not. Now, I want to say something that may sound like a contradiction. I do not think this means treasuries are suddenly irrelevant. I think it means the hierarchy inside fixed income matters more than ever. There is a huge difference between long duration exposure at the mercy of this repricing cycle and short duration claims that preserve optionality while avoiding much of the duration violence. That distinction is not a technical footnote. It is one of the central choices an investor must make in this environment. If the sovereign must keep paying up to refinance, long duration paper can become a punishing place to seek safety. Short duration paper, by contrast, lets you earn preserve flexibility and step away from making a giant multi-year interest rate bet on a funding structure that is visibly under more strain than the consensus wants to admit. That is why I do not confuse all bonds with one another. I want to know what job they are being asked to do. If the job is to preserve capital and optionality during refinancing stress, then short bills still make sense. If the job is to provide a sleepy ballast through an environment of structurally rising funding costs, long paper looks much less friendly. This brings me to the dollar. People are too lazy with the dollar story. They think the dollar is either collapsing tomorrow or permanently dominant forever. Reality is more subtle and more dangerous. Reserve currencies do not usually die in one dramatic act. They erode at the margin. The world builds alternatives quietly. Trade routes shift slowly. Reserve preferences adjust slowly. Payment rails diversify slowly. And all of it feels almost irrelevant until you wake up and realize the old automatic behavior is simply not as automatic anymore. That is what matters about foreign selling. It is not just the 1-month number. It is what the number sits inside. A longer drift away from unquestioned treasury absorption, a longer drift toward reserve diversification, a longer drift in which allies and non-allies alike begin asking whether the architecture of their reserves should be less dependent on one sovereign, one politics, one sanction regime, one fiscal path. That is not anti-American fantasy. That is institutional self-protection. And self-protection scales. Now, let me tell you how I would think about positioning inside this world, because diagnosis without positioning is just a more elegant form of helplessness. First, I would refuse to be a hero in long-duration sovereign paper. Not here. Not while the market is signaling that funding privilege is weakening, and the refinancing wall is this large. I would rather own short treasury bills than long bonds if my goal is safety with flexibility. Second, I would own some real assets, because if the resolution to debt stress eventually requires easier money, more financial repression, or more inflation tolerance, then not every dollar I own should depend on the purchasing power of dollars behaving as politely as they did in a calmer era. Gold has a role here. Energy has a role here. Scarce real things matter when the measuring stick becomes politically inconvenient. Third, I would avoid confusing index convenience with actual diversification. A market cap weighted index in this environment is often a concentration bet on expensive duration, mega cap optimism, and old regime assumptions about funding conditions. That is not prudence. That is outsourced judgment. Fourth, I would keep cash or very short liquidity, because if funding stress really begins expressing itself more violently, the best opportunities will not appear while you feel calm. They will appear when someone else is being forced to sell something wonderful in order to survive something urgent. That is when cash stops looking boring and starts looking sovereign. This is why I think optionality is one of the most underrated assets in the world. It is not just about surviving, it is about being one of the few buyers left when the market stops debating and starts clearing. Fifth, I would respect the bond market more than the talking heads. The bond market is still the lie detector. Equities can stay romantic longer. Bondholders are colder when the sovereign has to refinance $10 trillion and foreign reserve managers are stepping back. The message coming out of the long end matters more than 1,000 cheerful strategist notes. Now I want to give you the deeper metaphor that sits underneath all of this. A country that finances itself cheaply becomes accustomed to walking on marble floors. Every decision assumes the floor will hold. Then one year the marble begins to crack. Not because the building fell, because too much weight accumulated. At first only the architects notice, then a few lenders, then some foreign guests. The people inside still keep dancing because the chandelier is beautiful and the orchestra has not stopped. But once the guests start leaving and the host must refinance the repairs while the floor is splitting underfoot, the party changes tone fast. That is America in this cycle. Still wealthy, still central, still powerful, but no longer entitled to assume the floor will remain perfectly smooth just because it always did before. That is the regime change, And regime changes are where ordinary investors get hurt because they keep using the emotional habits of the old world in the arithmetic of the new one. They say treasuries always catch a bid. They say the Fed always finds a way. They say deficits always get managed eventually. They say markets always recover. All of that can be true in broad historical abstraction and still be financially useless if you are holding the wrong duration, the wrong concentration, and the wrong assumptions at the wrong point of the cycle. That is what matters, timing and structure, not slogans. Now let me tell you the real danger. The real danger is not that the United States wakes up one morning unable to fund itself. The real danger is slower and in some ways crueler. It is that each refinancing cycle locks in slightly worse terms. Each round of foreign diversification makes the next auction a little less forgiving. Each rise in interest cost makes the fiscal debate more brittle. Each geopolitical shock reveals that the old automatic demand is not as automatic as people believed. And because it happens in increments, the political class keeps choosing the least painful immediate option: more borrowing, more accommodation, more rhetoric, more denial, until the compounding itself becomes the policy. That is what late cycle traps look like. They do not require one dramatic failure. They only require repeated inability to choose the hard cure. Now, I want to leave you with the 5 questions I would ask my own portfolio if I were trying to live intelligently in this world. If foreign demand weakens further, what in my portfolio benefits and what gets hurt? If long rates stay structurally higher, what in my portfolio was only safe by habit? If the dollar remains strong for a while before eventually weakening under debt pressure? Do I understand which of my exposures need which environment? If the government is forced toward easier money later to manage the debt burden, what do I own that cannot be diluted? And if the best buying opportunities appear only after the crowd finally notices the harbor is shallower than it looked, do I have the liquidity to act then? That is a grown investor's checklist. Not because it sounds dramatic, because it forces you to stop speaking in headlines and start speaking in structure. The final choice is not whether you are bullish or bearish. That language is too shallow for what is happening. The final choice is whether you want to be a passenger in a refinancing regime that is visibly getting more fragile, or whether you want to become the kind of investor who understands funding chains well enough to stop confusing past privilege with permanent law. That is the threshold. That is the contract. I will not assume automatic buyers remain automatic. I will not pretend 10 trillion of refinancing is just another number. I will not call a weakening safe haven response normal. I will respect the bond market. I will shorten duration where safety is the goal. I will hold real assets where debasement is the risk. I will preserve optionality while the system is still pretending the old architecture is intact. And I will remember that the most dangerous moment in a debt regime is not when the crisis is finally obvious. It is when the market is still calling it manageable and the structure is already quietly changing underneath everybody's feet. That is where we are, and the investors who understand it now are not guaranteed an easy road. They are simply far less likely to be surprised when the old road stops being drivable.